The Intelligent Investor by Benjamin Graham is not merely a book about money. It is a quiet revolution disguised as a financial manual. And the moment a person opens its pages, they step into the mind of a man who saw the stock market not as a casino of luck, but as a battlefield of temperament, and to understand why Warren Buffett once called it by far the best book on investing ever written, one must first imagine a world in 1949, where ordinary people were being seduced by Wall Street's glittering promises only to be crushed again and again by their own emotions. And into that chaos walked Benjamin Graham, a professor, a philosopher, and a survivor of the 1929 crash, who decided that the average investor did not need more intelligence, more information, or more luck, but rather a framework of discipline so powerful that it could protect him from the most dangerous enemy he would ever face, which is himself. And this is the silent thesis that runs through every chapter of the book. The idea that investing is not about predicting the future, but about preparing for it. Not about being smarter than the market, but about being more patient than the crowd. And Graham begins by drawing a sharp and unforgiving line between two types of market participants, the investor and the speculator, explaining through countless examples that the speculator chases price movements hoping to sell to someone more foolish at a higher tomorrow, while the investor studies the underlying business, evaluates its worth, and buys ownership in it, the way a careful merchant would buy a shop, demanding to know its earnings, its debts, its assets, and its prospects before parting with a single rupee. And Graham insists that anyone who blurs this line, who tells himself he is investing while actually gambling on tickers and trends, is walking blindfolded toward financial ruin. And from this foundation, he introduces what may be the most beautiful metaphor in the history of finance, the character he calls Mr. Market, a manic-depressive business partner who appears at the investor's door every single day offering to either buy his shares or sell him more at wildly fluctuating prices, sometimes euphoric and quoting absurdly high numbers, sometimes terrified and offering bargains at panic-driven lows. And Graham teaches that the intelligent investor's job is never to be infected by Mr. Market's moods, but to use them. To sell when Mr. Market is greedy and to buy when Mr. Market is fearful, treating the man's emotional swings as opportunities rather than signals. And this single mental shift, the author argues, separates those who build wealth across decades from those who lose it across weekends. And then Graham deepens the lesson with what he calls the margin of safety, a concept so central to his philosophy that he describes it as the three most important words in investing, meaning that one must never buy a stock at the price it appears to be worth, but only at a meaningful discount to that value, because the future is uncertain, businesses can stumble, economies can crash, and management can fail, and only by paying significantly less than the estimated intrinsic value of a company does an investor create a cushion thick enough to absorb errors of judgment and accidents of fate. And Graham illustrates this with the analogy of building a bridge, explaining that a bridge meant to carry 10,000 pounds is always engineered to hold 30,000, and in the same way an intelligent investor never invests at the edge of his calculations, but always with a wide and humble margin between price and worth. And from these foundational ideas, the book then divides its readers into two camps, the defensive investor and the enterprising investor, not based on age or income, but based on willingness to devote time, study, and emotional energy to the craft of investing. And to the defensive investor, Graham offers a remarkably simple yet powerful strategy of holding a balanced portfolio split between high-grade bonds and high-grade common stocks, never letting either fall below 25% or rise above 75%, rebalancing periodically so that market movements automatically force one to sell what has become expensive and buy what has become cheap. And within the stock portion, he recommends owning a diversified group of large, prominent, and conservatively financed companies with long histories of consistent dividends, bought at reasonable price-to-earnings ratios. And he insists that such an investor should adopt the practice of dollar-cost averaging, putting equal amounts of money into the market at regular intervals regardless of price, because this mechanical discipline strips away the paralysis of timing and quietly converts volatility into an ally rather than an enemy. And to the enterprising investor, the one willing to roll up his sleeves and study balance sheets late into the night, Graham offers a far more demanding path, the path of seeking out undervalued securities the market has overlooked, of buying bargain issues whose net current assets alone exceed their market price, of analyzing secondary companies that lack glamour but possess sound fundamentals, of considering special situations like mergers and arbitrages, and he warns that this path requires not only more intelligence, but more emotional stability, because the very stocks that offer the greatest opportunity are usually the ones the crowd despises, and to hold them while others mock requires a conviction grounded in analysis rather than in approval. And throughout the book, Graham hammers again and again on the psychological dimension of investing, reminding the reader that the investor's chief problem and even his worst enemy is likely to be himself, that markets do not destroy wealth, panic does, that bull markets do not create fortunes, restraint does, and he documents how the most catastrophic losses in financial history were not caused by complex events, but by simple human emotions, by greed during euphoria, and by fear during decline. And he argues that the discipline of having a written plan, of pre-committing to rules about when to buy and when to sell, is the only reliable defense against the storms of one's own mind. And Graham then turns to the world of stock analysis itself, explaining how to read an annual report not as a marketing document but as a forensic statement, how to look beyond the headlines of earnings per share to examine the quality of those earnings, how to detect inflated profits hidden behind aggressive accounting, how to evaluate management not by their speeches but by their record of allocating capital, how to understand the difference between price and value, between popularity and merit, between a great company and a great investment. Because, as he memorably argues, even the finest business in the world can become a terrible investment if purchased at too high a price. And even an ordinary business can become a wonderful investment if purchased at a deep enough discount. And this distinction between business quality and purchase price is one that Graham insists most investors never truly internalize, which is why they so often confuse the success of a company with the success of their investment in it. And as the book progresses, Graham takes the reader through historical case studies that read almost like detective stories, exposing the recurring patterns of financial folly, the IPO manias where new and unproven companies were sold at insane valuations only to collapse within years, the conglomerate fevers where corporations grew by acquisition until their accounting became indecipherable, the stock split illusions, where investors celebrated the cosmetic multiplication of shares as though it created new wealth. And through these examples, he gently but firmly teaches that the financial world is governed by cycles of enthusiasm and despair, that history does not repeat itself in specifics, but rhymes endlessly in psychology, and that the investor who studies the past is better armed for the future than the one who chases the latest trend. And Graham also dedicates significant attention to the relationship between the shareholder and the corporation, reminding readers that owning a stock is not merely holding a slip of paper, but holding a fractional ownership in a real business with real employees and real obligations, and that shareholders have rights and responsibilities to question management, to demand transparency, to vote intelligently, and to view themselves as owners rather than as ticket holders in a lottery. And he laments that most shareholders behave passively, treating their holdings as gambling chips rather than as productive assets. And this passivity, he argues, enables the worst excesses of corporate behavior. And then comes Graham's famous teaching that in the short run, the market is a voting machine reflecting popularity contests of fear and greed, but in the long run, it is a weighing machine reflecting the true earnings power and intrinsic value of businesses. And this single line, more than any other, captures the essence of his entire philosophy, because it tells the patient investor that no matter how irrational prices may become in the short term, time itself acts as a corrective force, eventually pulling prices back toward underlying value, and the investor who buys good businesses at fair prices and waits with patience and discipline will be rewarded not by clever timing, but by the slow gravity of fundamentals. And Graham further explores inflation as a silent thief that erodes the purchasing power of bonds and cash, arguing that this is one of the strongest reasons for the defensive investor to maintain a meaningful allocation to stocks, even when the market feels frightening. Because over the long term, the defensive investor to maintain a meaningful allocation to stocks, even when the market feels frightening. Because over the long term, the productive output of well-chosen businesses tends to outpace the corrosion of inflation in a way that fixed income instruments cannot match. And he balances this with warnings against putting everything into stocks, reminding that diversification across asset classes is itself a form of margin of safety, protecting the investor not only from bad companies, but from bad scenarios. And as the book moves toward its final lessons, Graham introduces the idea that successful investing is fundamentally about character rather than intellect, that a person with average intelligence and strong discipline will outperform a brilliant person with weak discipline almost every time, that the investor's edge does not come from secret knowledge or sophisticated formulas, but from the simple ability to think independently, to act rationally when others are emotional, to remain calm in chaos and skeptical in euphoria. And he illustrates this through the story of his own students and disciples who, armed with nothing more than his straightforward principles, went on to build extraordinary records of wealth simply by refusing to participate in the recurring follies of the crowd. And Buffett's famous commentary appended to the modern editions reinforces this with a brilliant essay called The Super Investors of Graham and Doddsville, where he documents how a small group of investors who all learned from Graham produced decades of superior returns using widely different specific strategies but united by the same core philosophy of value, margin of safety, and emotional discipline, proving statistically that their success was not luck but method. And through all of this, the book quietly transforms in the reader's mind from a manual about stocks into a manual about life. Because Graham's lessons about patience, humility, independence, and discipline reach far beyond finance and touch the deeper question of how a thoughtful person should engage with an uncertain world. And one begins to see that the intelligent investor is not merely someone who manages money well, but someone who manages himself well, who has learned that wealth is not built in the dramatic moments of brilliant decisions, but in the unremarkable decades of consistent restraint, who understands that the market will always offer temptations to abandon one's principles, and that the entire purpose of those principles is precisely to be held when abandoning them feels easiest. And Graham closes the work not with a triumphant promise of riches, but with a sober reminder that investing is a marathon, that the goal is not to outperform every year, but to avoid catastrophic mistakes, not to find the perfect stock, but to build a resilient portfolio, not to predict the market, but to participate in it intelligently across the full arc of a lifetime. And he reminds the reader one final time that the margin of safety is everything, that diversification is essential, that Mr. Market is a servant and not a guide, that price is what you pay and value is what you get, and that the investor who internalizes these truths will not only protect his capital, but will earn returns that compound quietly and powerfully across the years. And as one closes the final page of The Intelligent Investor, one realizes that Benjamin Graham has not handed his reader a get-rich-quick scheme nor a complicated trading system, but something far more precious, a way of thinking, a temperament, an intellectual armor that can withstand every market cycle, every panic, every bubble, and every fashion that Wall Street will ever invent. And in a world where financial advice grows louder and more sensational with every passing year, Graham's voice from 1949 still speaks with a calm authority that no algorithm can replicate, whispering to anyone willing to listen that the road to lasting wealth is not paved with excitement, but with patience, not with prediction, but with preparation, not with cleverness, but with character. And that in the end, the intelligent investor is simply the person who has accepted this truth and chosen to live by it long after others have forgotten. And this is why decades after its first publication, the book continues to sit on the desks of the world's greatest investors, why it is reread and underlined and quoted across generations, and why anyone who is serious about building wealth without losing his peace of mind must eventually come to its pages, because in a noisy world, it offers silence. In a greedy world, it offers discipline. In a fearful world, it offers courage. And in a complicated world, it offers the rarest gift of all, which is clarity. The clarity to understand that investing, like life, rewards not those who run the fastest, but those who walk the steadiest, not those who shout the loudest, but those who think the deepest, and not those who chase the market, but those who quietly, patiently, and intelligently let the market come to them. And this is the timeless gift that Benjamin Graham left to the world, a gift that does not age, does not expire, and does not fail. A gift that turns ordinary savers into intelligent investors and intelligent investors into free human beings who have mastered not just their money, but themselves. And that, in the end, is the true meaning of the book. The quiet revelation that wealth is not what one accumulates in a bank account, but what one becomes in the process of building it with wisdom, discipline, and an unshakable margin of safety against the only true risk in investing, which is the risk of losing oneself to the madness of the crowd. And so the story of the intelligent investor ends not as a financial lesson, but as a moral one. A reminder that in markets, as in life, the greatest fortunes are built not by the boldest, but by the wisest. And that wisdom, unlike luck, is something every reader of this book can choose to cultivate one calm and rational decision at a time, until the day comes when he looks back across the decades and realizes that he did not just grow rich, he grew free, and that freedom, more than any number on any statement, is the final and truest reward of becoming an intelligent investor.